We're looking at a $200,000 amount, interest rate 6%. You're at the top bracket, 45%. The 6% interest saving over the year is about $12,000. The tax impact of that at 45 cents in the dollar is about $5,400, and multiply that out over a 25-year loan. We've got a saving of about $135,000. Hi there, I'm back this week with the second of two videos regarding loans and loan structuring. In the first week, we looked at the definitions: loan facility, offset, redraw. This week, we're going to run through a worked example of how to use an offset facility to the best tax effect. The setup here is you've built up some equity in your home and you keep your surplus cash in an offset account that benefits you from an interest perspective, paying the lower amount of interest. You can manage the cash flow impact of the higher repayments. You've sat down and you've decided that your next move is to buy an investment property. You want to get the best tax effect out of this, as we all do. Why this matters? There is a difference between dragging this money directly out of the offset, being your own cash savings, or out of a loan. And this can save you multiple tens of thousands of dollars over the life of the loan. We'll run with some pretty simple numbers just to keep the maths easy for my little brain. It's an $800,000 purchase requiring a $160,000 deposit, being 20% to avoid lender's mortgage insurance, and the stamp duty will be about $40,000. In this instance, total upfront cash needed is about the $200,000. Now, obviously, your stamp duty is going to vary depending on your state and things like that, but stay with me. Again, nice easy numbers for my maths. There are two ways to fund this $200,000 deposit and stamp duty. And the wrong way, I suppose, firstly, would be to look at your cash sitting in that offset account and just drag that money out of there. When you drag that money out of there, you're using your own cash, your savings, and therefore there is not a borrowing. In this instance, only the 80% that you borrow over the investment property itself will be deductible for interest purposes. If you do it the right way and do this in a two-step process, you get a very different outcome. Step one would be to transfer the $200,000 from the offset into your loan account. Step two would be to draw the deposit and the stamp duty directly out of that redraw facility, the loan facility itself, and pay that money to the stamp duty office and the solicitor's trust account. And what we have here is a borrowing. We have drawn money directly out of a loan, and therefore we have a borrowing. And the important distinction is now, because we have that borrowing, the ATO asks, what is the purpose of that borrowing? And because we've used that money for an income producing asset, the investment property, all of a sudden we have a loan that is 100% plus stamp duty, fully deductible for tax purposes. This has a very, very different outcome. It's really important to get the order of those steps right, to pay the money directly to the solicitor's trust account or to Revenue New South Wales or whatever state duties office there is. And it's really important as well to make sure that your notes on that statement are very clear. Deposit, stamp duty. Be very careful though. If you drag that money out of the redraw facility into your everyday account, you can cause yourself grief and result in exactly the outcome that we don't want. Now again, I use some nice easy figures, nice round figures for my maths. If we just quickly do the maths and have a look and see at what this saving is, we're looking at a $200,000 amount, being the deposit plus the stamp duty. If we call the interest rate 6%, and we say that you're at the top bracket, nice and easy again, 45%. The 6% interest saving over the year is about $12,000. The tax impact of that at 45 cents in the dollar is about $5,400. Now, if we ignore rate changes and balance adjustments and all that sort of thing and multiply that out over a 25-year loan, we've got a saving of about $135,000. And this, guys, is where it's really important to get these transactions right and to set up your loan, structure your loan appropriately. And because of the need to get it right, this is where a good accountant or tax advisor and a good broker will be worth their weight in gold. Talk to your accountant before you do anything there. We like to be looped in to the broker so that we can understand how they approach this. And the earlier you talk to the accountant or tax advisor, the better. They can just do a good sense check with the broker and understand, are they looking at loan splits and things like that to make it nice and easy. We like to just step out very quickly and briefly the flow of funds to really make it nice and clear, to show how that should work, the timing and order. And this is the power of an offset used with precision. Same property, same price, and vastly different tax outcome. Getting the right advice from an accountant and broker who work regularly in this space mean that you can save significant funds and perhaps get into your next investment sooner. I'm TC, and that's my 2 cents. Now, before you jump, if you found this useful, like or subscribe and share with anyone who might be interested. The content is for information purposes only. Get your own specific tailored advice. This is not financial advice. I am a poor, simple bean counter and not a substitute for good quality financial advice. If you've got a question or a topic that you'd like me to cover, set it out below or send me an email at tc@tcs2cents.com.au. If you're looking for tailored guidance to boost your business or tax advice or tax results, visit atomicba.au or email us at admin@atomicba.au and see if our team can help you go to the next level.